Chapter 1: Investment versus Speculation. What smart investors expect. In this chapter, Graham goes into detail about the difference between investment and speculation, which was touched on in the introduction. Graham explains that investment is an action that is taken after careful analysis, with the consideration and promise of safety of capital, and that it can provide a reasonable return. Therefore, actions that do not result in these three things can be considered speculation. Note that according to Graham, investing is an activity that has at least three important elements, namely, 1. An investor must carry out a continuous and thorough analysis of the stocks of the companies he is going to include in his portfolio. The stocks must have good fundamental strengths, such as the viability of the business, the professionalism of the management running it, the availability of resources that can help the company to continue to grow, and the sustainability of the company's business in the future. 2. An investor should also act prudently in a manner and with a portfolio allocation that can minimize losses and protect him or her from losing most of his or her investment. 3. An investor will consider achieving reasonable performance rather than exceptional performance of his invested assets. This is because an investor has a real principle that security in investing is as important as the rate of return. From these 3 points, we can compare that what is meant by speculation are actions that do not fulfill some or all of the points described by Graham. An investor calculates the value of a share based on the value of the business the company runs. A speculator, on the other hand, gambles that a share will go up in price because someone else will want to pay more for it one day. A speculator does not trade on the fundamental value of the company, whereas an investor analyzes the company's business and then determines the price of the company. A speculator looks at the price and then predicts the price of the company in the future. This is certainly a very risky way to invest our money. If we only buy company shares through the speculator mechanism, all we will be doing is short selling. It is possible to make instant wealth, but remember that the risk of failure in this speculative activity is also enormous. Graham mentioned that the only people who benefit from this type of transaction are the brokerage firms. They don't care whether you make a profit or a loss that day. By the time the bell rings, they will have pocketed their commission on your trade. Even if we do the 3 things Graham suggests, we may still inadvertently get caught up in speculation. These days, there is almost always a speculative component in the stocks we hold in our investment portfolios. Our job, therefore, is to keep the speculative component to a minimum and to be financially and psychologically prepared for the unexpected in the future. The most important thing to understand about Wall Street is that you should not be fooled into thinking you are investing when you are actually speculating. You should never take speculation seriously, as it can be deadly and threatening to your assets. And finally, you should set firm limits on the amount of assets you are willing to risk to minimize the impact of the inevitable speculative factors. In this chapter, Graham also discusses the results that defensive and aggressive investors can expect, as mentioned in the previous chapter. Graham explains that defensive investors, who do not want to get too involved in lengthy decisions and who are concerned about the comfort of investing, should always have a significant portion of their funds in bonds and a significant portion in equities. The bonds and shares chosen should be of good quality and not be subject to significant fluctuations, such as shares in companies with a long history, consistently profitable operations, and healthy finances, and they should refrain from choosing new stocks or securities that are booming. As for aggressive investors, Graham stresses that aggressive investors should start with a clear idea of which actions have a reasonable chance of success and which do not. Graham still firmly believes that the technique of selecting stocks traded on the stock market can still deliver above-average returns, which is the goal of aggressive investors. Graham believes that among the many stocks traded, there will still be stocks that are undervalued by any reasonable and logical standard. Such stocks will provide more satisfactory returns than what defensive investors can easily achieve. In the next chapter, Graham discusses a factor that is also very important for investors to consider: inflation.